Ever wondered how Warren Buffett, one of the world's richest men, invests his money? Imagine a world where you could peek into the mind of the Oracle of Omaha himself and apply some of his investment wisdom to your own portfolio. Even if you're only investing small sums of money, the principles remain the same. Warren Buffett, the CEO of Berkshire Hathaway, is not just a billionaire. He's a self-made billionaire, which makes his story even more compelling. Born into a modest family, Buffett's journey to becoming one of the wealthiest men in the world started with selling chewing gum and Coca-Cola door-to-door. His tale is a testament to the power of smart, patient investing. Buffett's investment philosophy can be broken down into a few key principles. First and foremost, he believes in value investing. This means focusing on companies that are undervalued in the market, with strong fundamentals and solid growth potential. But it's not just about picking the right stocks, it's also about knowing when to hold on to them. Buffett is famous for his long-term investment approach, often holding on to stocks for decades. Another cornerstone of Buffett's investment strategy is diversification. He believes in spreading investments across a variety of sectors and industries, mitigating the risk that comes with putting all your eggs in one basket. But crucially, Buffett doesn't just invest in anything and everything. He emphasizes the importance of research and understanding the businesses you're investing in. So, how can you apply these principles to your own investment strategy, even if you're only investing small sums of money? The key lies in being disciplined, patient, and thoughtful with your investments. It's about understanding the value of a company, not just its price. It's about being patient and holding on to your investments even when the market is volatile. It's about diversifying your portfolio, but not at the expense of understanding your investments. Now, let's delve into the specifics of his investment strategies. One of the key principles in Buffett's investment philosophy is the power of compounding. Now, what exactly is compounding? Well, it's a simple yet powerful concept. It's the process where the returns on an investment start to earn returns of their own. In other words, it's the snowball effect. You start with a small snowball, and as it rolls down the hill, it gets bigger and bigger, collecting more snow along the way. Let's break it down further. Suppose you have $100 and you invest it in a venture that gives you a 10% return. At the end of the year, you'll have $110. If you leave that sum invested, the following year, you'll earn a 10% return not just on your original $100 but also on the $10 you earned. This might seem small at first, but over time, these small amounts add up. Now, how does Buffett use this to his advantage? Well, he's a long-term investor. He doesn't just invest his money and pull it out after a year or two. He leaves it in, allowing it to compound over time. And when you're dealing with large sums of money and long periods of time, those compounded returns can become incredibly significant. Buffett once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." His strategy is all about buying and holding onto investments for the long term and letting the magic of compounding do its work. But remember, compounding doesn't just work in the positive direction. It can also work against you if you have debts with high interest rates. That's why it's important to understand this principle and use it wisely. In the grand scheme of things, compounding is like a slow cooker. It might not seem like much is happening in the short term, but give it time, and you'll be amazed at what it can do. As we can see, compounding is a powerful tool that can turn small sums into large fortunes. Another key element in Buffett's strategy is value investing. Now, you might be wondering, what exactly does this mean? Well, value investing is a strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Basically, it's like bargain hunting, but in the world of stocks and shares. Warren Buffett himself once said, "Price is what you pay, value is what you get." This is the essence of value investing. It's about finding stocks that are undervalued, which means they are priced less than their actual worth. The idea is that these stocks will eventually rise to their true value, providing a healthy return for the investor. Let's think of it this way. Imagine you're at a yard sale and you find a rare vintage piece of furniture priced way below its worth. As a smart shopper, you'd buy it, right? That's what value investing is all about, but instead of furniture, we're dealing with stocks. Now, how does Buffett use this strategy? Well, he spends a lot of time researching companies. This isn't about just looking at the numbers. He dives deep into understanding the business, its management, its competitive edge, and its prospects for the future. Only then does he decide whether a stock is undervalued and worth investing in. Buffett's strategy isn't about making quick bucks. It's about patience and holding on to stocks for the long term. He's not swayed by market fluctuations or short-term trends. Instead, he waits for the market to recognize the true value of the stocks he has invested in. So, how can you apply this strategy? Start by educating yourself about the companies you're interested in. Understand their business models, analyze their financials, and evaluate their market potential. Then, make your own assessment of what their stocks are worth. If the market price is less than your estimated value, it might be a good investment. In essence, value investing is about finding bargains in the stock market. So, if you're ready to put in the time and effort, you too can become a value investor, and who knows, maybe even the next Warren Buffett. Buffett is also a well-known advocate of long-term investing. So, what exactly is long-term investing and why is it beneficial? In essence, long-term investing is the practice of buying and holding investment securities for a prolonged period, typically for at least a few years. The key advantage of this approach is that it allows investors to ride out market fluctuations and take advantage of the power of compounding. Long-term investing is not about making quick wins, it's about sticking to a game plan and patiently waiting for your investments to grow. This is a strategy that Warren Buffett himself has championed throughout his illustrious career. For instance, when he first invested in Coca-Cola in the late 80s, he didn't sell off his shares at the first sign of profit. Instead, he held on to them, and that patience has paid off handsomely. Today, those shares are worth several times their original value. Buffett's strategy is rooted in the belief that if a company is strong and well-run, its value will inevitably increase over time. This approach has allowed him to avoid the pitfalls of short-term market volatility and focus on the bigger picture. By investing in companies he believes in and holding on to those investments for the long term, he's been able to maximize his returns and build a portfolio that's the envy of the financial world. Now, it's important to note that long-term investing isn't about blindly holding onto stocks regardless of their performance. It's about making informed decisions and being patient enough to wait for those decisions to bear fruit. Buffett doesn't just buy and hold, he buys, holds, and monitors. He keeps a close eye on his investments, and if a company's fundamentals change for the worse, he's not afraid to cut his losses. In the end, the key takeaway from Buffett's approach to long-term investing is this: patience is a virtue. In the world of investing, it can often be the difference between success and failure. Patience, it seems, is one of the key ingredients in Buffett's recipe for investment success. Diversification is another important principle in Buffett's investment philosophy. This principle goes hand in hand with the other strategies we've discussed, acting as a safety net that can protect your investments from the unpredictable swings of the market. So, what exactly is diversification? Picture it as a game of chance, like rolling a dice. If you bet all your money on rolling a 6, you stand to lose everything if any other number shows up. But if you spread your bets across different numbers, your chances of losing everything decrease. In the world of investing, diversification follows the same principle. It is the practice of spreading your investments across different areas, whether that's different industries, different types of assets, or different geographical locations. Why is it important? Well, diversification mitigates risk. It acts as a buffer against the volatility of the market, ensuring that a drop in one area doesn't wipe out your entire portfolio. Because let's face it, even the most astute investors can't predict with absolute certainty which investments will succeed and which will fail. Now, how does the Oracle of Omaha, Warren Buffett, leverage diversification? Buffett is known for his focus on value investing, but that doesn't mean he puts all his money on one stock or one industry. He understands the importance of having a diversified portfolio. His investments span across various sectors, from technology to finance, healthcare, and consumer goods. This broad spread allows him to weather downturns in any particular sector, protecting his overall portfolio. However, it's important to note that while diversification can mitigate risk, it doesn't eliminate it completely. It's a tool to manage risk, not a magic wand to make it disappear. That's why it's crucial to pair diversification with careful research and thoughtful strategy, principles we'll explore in the next scene. As the saying goes, don't put all your eggs in one basket. With diversification, you're not just betting on a single number, but spreading your bets to increase your chances of a winning roll. Buffett is known for his meticulous research before making any investment. Research is the compass guiding the journey of investment. It's the tool that helps you navigate the financial landscape, avoid pitfalls, and discover hidden treasures. Now you might wonder, why is research so pivotal in investing? The answer is simple. Informed decisions are smarter decisions. Warren Buffett, one of the greatest investors of all time, is a testament to the power of diligent research. He doesn't just throw his money at any attractive prospect. Instead, he delves deep into the fundamentals of a company, understanding its operations, its market position, its financial health, and its future potential. This isn't just about reading financial statements, though that's certainly part of it. Buffett is known to read 5 newspapers a day, and he spends about 80% of his day reading and thinking. This isn't just to keep up with current events, but to gain insights into the economic climate, industry trends, technological advancements, and so much more. His research doesn't stop at the macro level either. He takes a deep dive into the micro level, understanding the nitty-gritty details of a company. He looks at the quality of the management, the company's competitive advantages, its pricing power, its customer base, and its potential for growth. By doing this, Buffett isn't just investing in a company, he's buying a piece of a business. He's not just a spectator, he's a partner in the company's journey. And this is why he can make such confident, long-term investment decisions. He knows what he's getting into, and he believes in the company's potential. This meticulous approach to research has been a key factor in Buffett's success. He doesn't gamble, he invests. And that's a crucial distinction. Gambling is about luck. Investing is about making informed decisions based on research. So the next time you're considering an investment, remember the importance of doing your homework. Dive into the details, understand the business, and make an informed decision. Knowledge is power, and this is especially true when it comes to investing. To sum up, Buffett's investment philosophy can be boiled down to a few key principles. We began our journey by understanding the billionaire's investment strategy. Let's recap. Warren Buffett, a name synonymous with wealth and investment wisdom, has a simple yet powerful approach. He believes in the power of compounding. This principle, often referred to as the eighth wonder of the world, is the process of earning interest on interest, which can turn even tiny sums into substantial amounts over time. By investing small sums regularly and letting the interest compound, your money can grow exponentially. Next, we delved into the concept of value investing. Buffett is a staunch believer in this principle, which involves buying securities that appear underpriced by some form of fundamental analysis. In simple terms, he invests in companies that are undervalued in the market, but have strong fundamentals and potential for growth. This strategy requires patience and discipline, as it often involves going against the market trend and waiting for the market to recognize the true value of the investment. Our journey then led us to the principle of long-term investing. Buffett is not a trader, he is an investor. He believes in buying and holding on to investments for an extended period, often for many years or even decades. Long-term investing allows for compounding to work its magic and also reduces the impact of short-term market volatility on the investment. As Buffett says, our favorite holding period is forever. We then explored the principle of diversification. While Buffett warns against mindless diversification, he acknowledges its importance in managing risk. The idea is to spread your investments across different asset classes or sectors to reduce the risk of any single investment hurting your overall portfolio. However, Buffett also emphasizes the importance of understanding what you're investing in, hence leading us to the final principle. Finally, we discussed the importance of research. Buffett spends a significant amount of his time reading and analyzing financial reports. He believes in thoroughly understanding a company before investing in it. This involves analyzing the company's financial health, competitive position, and growth prospects, among other factors. These principles form the cornerstone of Buffett's investment philosophy. It's a philosophy that's not just about making money, but about understanding the value, having patience, managing risks, and making informed decisions. It's about investing wisely, not just investing more. By applying these principles, even small sums of money can grow into a substantial nest egg over time. Remember, it's not about how much you start with, but how you invest it that counts. As Warren Buffett says, someone's sitting in the shade today because someone planted a tree a long time ago. So, go ahead, plant your financial tree today, and let it grow.